The title: How Banks Create Money. Fractional Reserve Banking Explained. Script: banks operate on a razor's edge, lending out far more than they hold in reserve. This system is called fractional reserve banking. If too many borrowers default, the whole system collapses. But what if I told you this dangerous system is designed to benefit the banks and allows them to make enormous profits, leaving the rest of us holding the bag? Fractional reserve banking is basically how banks make money. When you deposit money, the bank doesn't just keep it locked away. They lend most of it out to other people. However, they have to keep a certain percentage of your deposit, called the reserve requirement, as reserves. This reserve requirement is set by the central bank. Let's say the reserve requirement is 10%. If you deposit $100, the bank can lend out $90. Now here's where it gets interesting. The person who borrows that $90 might deposit it in another bank. That bank can then lend out 90% of $90, which is $81. This process continues, with each new loan creating a new deposit. This is called the money multiplier effect. It means that the initial deposit of $100 can actually create much more money in the economy. The formula to calculate the money multiplier is 1 over reserve requirement. So, with a 10% reserve requirement, the money multiplier is 10. This means that the original $100 could theoretically create $1,000 in the money supply. The central bank uses several tools to influence this system. They can change the reserve requirement, making banks lend out more or less money. They can also use open market operations, which involves buying or selling government bonds to inject or withdraw money from the system. Another tool is the discount rate, which is the interest rate at which commercial banks can borrow money directly from the central bank. Fractional reserve banking allows banks to create credit and fuel economic growth by increasing the money supply. It enables businesses to borrow money for investment and consumers to purchase goods and services. It also allows banks to make profits from the interest they charge on loans. However, the system isn't without risks. If too many people want to withdraw their money at the same time, the bank might not have enough reserves to cover all the withdrawals. This is called a bank run, and it can lead to the bank's collapse. That is why deposit insurance exists, which protects depositors' money up to a certain amount, preventing bank runs and ensuring financial stability. Another risk is that banks might take on too much leverage, meaning they borrow too much money relative to their capital. This can make them vulnerable to financial shocks and increase the risk of insolvency. Banks are supervised and regulated to help reduce these risks and maintain the safety and soundness of the financial system. Understanding fractional reserve banking is key to understanding how the financial system works. However, it is a complex system with many moving parts, and the degree to which this system benefits either the banks or the public remains a significant point of contention, and may benefit from additional research on subjects such as fair interest rates, loan practices, and financial regulations. If you found this video helpful, please give it a like, share it with your friends, and subscribe to our channel for more insightful content. Thanks for watching.